Welcome to the Deep Dive, the show that really tries to cut through the noise and get you straight to the insights you need.
Absolutely.
Have you ever genuinely wondered, if crypto has real, actual, intrinsic value?
It's the big question, isn't it?
Yeah, or if Bitcoin is just like a speculative bubble. Or is there something more substantial underpinning its price movements? And what actually makes crypto prices move? Beyond just gut feelings or, the latest tweet.
These are exactly the kind of questions that, they challenge investors and, frankly, anyone curious about this space. The crypto market can often feel chaotic, maybe even unregulated sometimes.
Definitely feels that way.
Driven purely by sentiment, by speculation. But imagine if there was a way to bring some analytical rigor to it all.
Okay.
Similar to how traditional finance values, established companies and their stocks.
Right. So that's basically our mission for this deep dive. We're aiming to give you a shortcut to understanding these really complex questions. Moving, hopefully, beyond just speculation to explore a pretty robust valuation framework.
Yeah, we've been digging into this comprehensive digital asset valuation framework. It's a document really designed to bring clarity, some structure to understanding the intrinsic value of these crypto assets.
And we're pulling out the core insights for you.
Exactly. And this framework, it isn't just theory. It's not some simple guide. It strongly suggests that successful crypto investing, it really hinges on solid value-based decisions.
Not just hype.
Not just riding waves of hype. No, it's about looking at what fundamentally backs these assets rather than just reacting to those constantly fluctuating market prices.
Okay, so let's unpack that. Why is crypto valuation so different? And why do we even need a whole new framework for it? Is it really that unique, or are we maybe overcomplicating things?
That's a fair question.
It seems to boil down to this fundamental concept, intrinsic value versus market price. They're definitely not the same thing, but, how dramatically can they actually diverge?
Well, that's precisely the core challenge, isn't it? Well, the idea of intrinsic value versus market price isn't new. Traditional markets see it all the time. Crypto seems to amplify it, maybe exponentially. Our source points out, even established giants like Apple saw their stock price plummet by 30% during the COVID crash back in February 2020.
Wow, 30%.
Or think about GIP. Its stock crashed by 70% in just 49 days during that same period.
70, good grief.
Right. And these were companies with strong underlying fundamentals. But their prices just tanked because markets are often driven by fear, by panic, not just logic or a company's, true worth.
And it's the same story, maybe even more extreme, with Bitcoin. Its price has swung dramatically. You mentioned that 50% drop in just 5 months during COVID?
Exactly. That kind of volatility naturally leads people to question its fundamental value. Is there anything real there?
Which is why this framework is so important.
Yeah, and that's exactly why this framework is crucial.
Yeah.
It emphasizes that a crypto asset isn't just some ticker symbol backed by, nothing.
Okay.
Instead, it fundamentally represents an underlying network, a specific utility, and essentially, you could call it a decentralized business.
A decentralized business.
Interesting.
Our goal today is really to help you, the listener, understand how to move beyond that fleeting market sentiment, beyond the speculation, to make more informed decisions about these digital assets. Okay. Now, the framework makes a critical point. You can't just slap one valuation method on every single crypto asset out there. But what makes them so fundamentally different that we need these entirely distinct approaches? Why can't we just treat them all like, say, Bitcoin?
That's a fantastic question, and it really gets to the heart of why this space is so complex, right?
Right.
It's because crypto isn't just one thing.
Right.
Imagine trying to value both a gold bar and, say, a tech startup using the exact same financial model. It just wouldn't make sense, would it?
No, definitely not.
Similarly, a native cryptocurrency like Bitcoin, which is designed primarily as digital money, it operates on a completely different economic premise than, say, a decentralized application platform like Ethereum. Ethereum functions more like a global computer.
Okay, so different functions, different models.
Precisely. The framework meticulously categorizes them because their underlying economic models, their utility, their potential for generating cash flow, it's all vastly different.
So what are those main categories the framework identifies then?
Well, it covers native cryptocurrencies, like Bitcoin itself, of course, then public chains or layer one solutions, think Ethereum and Solana.
Okay.
Decentralized autonomous organization tokens, or DAO tokens, utility tokens, security token offerings, STOs, and non-fungible tokens, NFTs.
Got it. Quite a list.
Yeah. And we're going to delve into a few of these, starting with probably the most well-known.
Okay, let's start our deep dive then into native cryptocurrencies. Putting Bitcoin right under the microscope, our source presents a really interesting concept right off the bat. Bitcoin as a decentralized financial institution.
Yes, it explores this, pretty audacious idea, doesn't it? Bitcoin potentially replacing or maybe complementing centralized financial institutions. And to help us grasp its current scale, the analysis compares Bitcoin's market cap, which was around $800 billion when this was written.
Which is huge already.
It's massive.
Yeah.
Compares that to major traditional telecom networks. Companies like China Mobile, about $182 billion, AT&T at $140 billion, T-Mobile around $186 billion.
So way bigger than even those giants individually.
Right.
So if Bitcoin is truly building this decentralized financial institution, how? How big could it actually get? The framework offers this really ambitious perspective, comparing Bitcoin's market cap not just to single companies, but to the entire global telecom sector.
Yeah, that's the kicker.
And the projection is pretty remarkable. If Bitcoin were to achieve that scale, its market cap could realistically grow by more than 5 times its current size. What specifically about Bitcoin's design or its global reach makes that kind of institutional replacement even, conceivable? Is it the decentralization, the security, something else?
I think it's the combination, really. It's decentralized, it's secure, it's permissionless, plus that program's scarcity and its global accessibility. It ticks a lot of boxes.
Okay.
And beyond these sort of macro comparisons, the framework also looks at the network's health. It uses something called Bitcoin's Moore's Law compensation, or BMLC.
Yeah.
And it highlights a positive correlation between Bitcoin's hash rate, that's the total computing power securing the network.
Right, the miners.
Exactly, between that hash rate and its price. Generally, a higher hash rate means a more secure network, which typically correlates with increased trust and value.
So how do we know if Bitcoin is over or undervalued based on this network strength? Is there a metric?
Yeah, the framework introduces the price hash rate delta ratio. It's presented as a useful indicator. It basically helps assess if Bitcoin's market price is out of sync with its underlying hash rate variation. Gives you a unique sort of fundamental lens.
Interesting.
And then moving to broader macroeconomic influences, the analysis discusses Bitcoin's price equilibrium adjusted to M2.
M2. That's the money supply, right?
That's the broad money supply, yeah.
Yeah.
Because Bitcoin supply is highly inelastic, meaning the total quantity doesn't really change much with price.
Fixed supply, essentially.
Pretty much fixed, yeah. So any substantial shifts in demand are going to heavily impact its price.
And what drives that demand then? What factors are key?
Well, the source details several. A big one is M2 money supply growth itself.
So when central banks print money?
Basically, yeah. When there's more liquidity pumped into the system. Other drivers include things like income elasticity, how demand changes with economic activity, and its increasingly recognized role as an inflation hedge.
Ah, the digital gold narrative.
Exactly, that moniker, digital gold.
So what's really insightful here are these strong correlations the source apparently uncovered.
Yes, this was quite striking. Bitcoin shows a 0.86 correlation with the M2 money supply.
Wow, that's high.
It is. And an impressive 0.90 correlation with the S&P 500.
Even higher. So wait, what does that actually mean?
Well, it's a crucial takeaway, I think. It really challenges that common narrative of Bitcoin being entirely independent or just a pure inflation hedge,
Right, like it's totally separate from traditional markets.
Exactly. Instead, this suggests that Bitcoin's price movements are, surprisingly, deeply intertwined with broader macroeconomic liquidity and traditional equity markets.
So understanding what the Fed is doing or how the stock market is trending might be just as important as crypto news for Bitcoin's price.
It certainly suggests that, very interconnected.
Okay, so given those strong correlations, what's the big projection coming out of this M2 model?
Well, hold on to your hat for this one. According to the framework's analysis, Bitcoin's price might actually hit $1 million by late 2032. $1 million per Bitcoin.
Per Bitcoin. Driven largely, the model suggests, by that M2 money supply growth.
That's a truly staggering figure. But I guess it underscores the potential impact of all that macro liquidity on this asset if the model holds.
It certainly is a bold projection based on those economic relationships, absolutely. Now, another model the framework discusses, focusing on scarcity, is the Bitcoin stock-to-flow model.
Ah, yes, stock-to-flow. I've heard a lot about that one.
It's quite well known. Its premise is pretty straightforward. Bitcoin's value is largely driven by its extreme scarcity. It compares the existing supply, the stock, to the new production from mining, the flow.
Right. And this model's been pretty popular, hasn't it? Famously projecting Bitcoin at $50,000, even higher levels.
It has, but it's also faced its share of criticism.
Yeah. Like what?
Mainly for largely overlooking the demand side of the equation. It focuses almost exclusively on that supply side scarcity, which some argue is only half the picture.
Makes sense. Demand has to matter. Exactly. And speaking of demand, let's talk about how the traditional and crypto worlds are kind of bridging, specifically through Bitcoin ETFs.
Ah, the ETFs. Big news recently.
Huge news. The framework highlights significant benefits for investors here. They can get exposure to Bitcoin through diversified portfolios, much simpler transactions, increased liquidity, greater transparency, and crucially, regulatory compliance.
Which opens the door for a lot more people and institutions, right?
A much wider audience, definitely. And this isn't just theoretical anymore, as you said.
No, we saw it happen.
The real-world impact became clear, with the SEC approving 11 Bitcoin spot ETFs back on January 11, 2024.
Yeah.
The analysis estimates their assets under management, their AUM, could reach over $1 billion. And what's particularly compelling is the potential market impact they calculated.
Okay.
The source estimates that a $1 billion inflow into these ETFs could lead to a substantial $10 USD impact on the Bitcoin price itself.
Wow, so you can actually see a direct link between institutional demand flowing in and the price moving?
It demonstrates how that new demand can directly influence the valuation, yes.
Okay, what other valuation methods are there for Bitcoin?
Well, another fundamental one is the cost of production method.
Cost of production. Like how much it costs to mine it.
Exactly. This calculates Bitcoin's value based on the estimated cost of mining a single Bitcoin. You factor in electricity consumption, hardware depreciation, operational overhead, all that stuff.
So this gives you a kind of quantifiable floor price tied directly to the real-world economics of mining.
Precisely. For example, the source cites the estimated break-even price for a major miner, Riot Blockchain, back in Q2 2023. It was $67,550 per Bitcoin.
$67,000 just to break even.
That was their estimated cost, yeah. That represents the combined cost of electricity, hardware, operations, the whole shebang.
So the insight here is that if Bitcoin's market price dips consistently below that kind of threshold, it becomes unprofitable for miners.
Right, which could potentially lead to miners shutting down, reducing network security.
Which could then impact its long-term value proposition. It's fascinating. Like these huge energy-guzzling operations are effectively setting a baseline for what Bitcoin is worth just to stay economically viable.
Kind of like the geological cost of extracting physical gold, in a way.
Yeah, good analogy. Okay, any other methods for Bitcoin?
One more for native cryptocurrencies. Network efficiency. Specifically, the transaction value to transaction fee ratio.
Okay, what does that measure?
It measures the overall efficiency and utility of the Bitcoin network, basically as a payment system, as a payment rail.
And the numbers are, well, they're pretty eye-opening, right? Especially when you think about Bitcoin as a global payments network.
They really are. Back in 2017, the average transaction value was over $27,000.
$27,000 on average.
Yep, yet the average transaction fee was just $10.27.
Only $10 to move almost 30 grand.
Think about it. For every dollar paid in fees, $6,583 in value was moved across the network.
Wow.
Right.
That's incredibly efficient compared to traditional finance for large transfers.
It's not just impressive stats. It's a profound insight into Bitcoin's potential to dramatically undercut traditional transaction costs, making it potentially a really compelling, low-cost global settlement layer.
And that's a core piece of its long-term intrinsic value proposition, right?
Absolutely. That truly showcases Bitcoin's foundational utility as this global money transfer network, and importantly, how we can apply rigorous metrics to actually understand its value.
Okay.
So we've explored these multifaceted ways to value a native cryptocurrency like Bitcoin, from its institutional dreams to scarcity, cost, efficiency.
A lot of different angles.
Very different angles,
Yeah.
But as we discussed earlier, not all crypto assets are the same.
Exactly. So the framework then pivots to public chains, often called layer ones, like Ethereum and Solana.
Mm-hmm.
These are fundamentally different beasts, aren't they? They serve as these decentralized networks that allow anyone to participate permissionlessly. Transactions are maintained, validated by this distributed network of nodes.
Right, they're the foundational infrastructure. They aim to provide security, decentralization, and scalability for a whole ecosystem of decentralized applications, or dApps.
But there's a catch, right? this trilemma thing.
Yes, the fundamental challenge here. The blockchain trilemma. It's this inherent trade-off between maximizing decentralization, security, and scalability all at the same time.
Hard to get all three perfect.
Notoriously difficult, yeah. It's a constant balancing act for these layer ones.
Okay, so for valuing something like Ethereum, the framework applies a traditional finance tool, the discounted cash flow model, DCF.
That's right. And what's clever here, or how it's adapted, is that Ethereum's transaction fees, the gas fees people pay.
Yeah, the sometimes painful gas fees.
Those fees are treated as revenue for the network. This makes the network kind of amenable to a DCF analysis, much like you'd value a traditional company that generates revenue from its operations.
Interesting. So you're projecting future revenue from fees and discounting it back.
Essentially, yes. And to determine the appropriate discount rate for Ethereum, they use the capital asset pricing model, CAPM.
CAPM, okay. Standard finance stuff.
Pretty standard. And they arrive at an expected return, or discount rate, of 11.14%.
Got it.
Furthermore, Ethereum has this unique mechanism, EIP 15599.
Right, the fee burning mechanism.
Exactly. It burns a portion of transaction fees. This actively reduces Ethereum's supply over time, potentially contributing to its value as a scarce asset, maybe even making it deflationary sometimes.
So what does this DCF model, factoring in fees and burning, actually suggest for future ETH prices?
Well, the source provides a range of estimated future ETH prices based on different assumptions. It goes from a baseline of about $2,016.
Right.
That's assuming a 4% terminal growth rate after 2030, but it goes up to a much more bullish $12,321 per ETH.
12,000, wow.
That's with a higher 10% terminal growth rate assumed after 2030. So quite substantial projections depending on those long-term growth assumptions.
Definitely. And what about Solana? Does DCF work for Solana too?
The framework does mention Solana valuation through DCF. It notes its incredibly high transaction processing speed, 5,273 transactions per second, which is huge.
Yeah, super fast.
But it also points out a key limitation for applying DCF directly and robustly. Solana's transaction fees are extremely low compared to Ethereum's.
So not much revenue to discount back.
Exactly. It makes that revenue-based DCF model more challenging to use in the same way. The numbers are just much smaller.
Okay, so beyond just fees, how else do we understand the value of these big networks? Network effects, right?
Absolutely. The framework revisits Metcalfe's law here.
Metcalfe's law.
Yeah.
The value is the square of the users. That one.
That's the one. It emphasizes network effects, stating that the value of a network is proportional to the square of the number of connected users, roughly speaking.
So for public chains like Ethereum and Solana, the power of network grows more users, more apps building on them.
That directly translates to potentially exponential value growth. The bigger the network gets, the more valuable it becomes much faster.
Got it.
Yeah.
Are there other ratios, like we saw with Bitcoin?
Yes. To help assess these chains, the NVT ratio network value to transaction volume is discussed again. For public chains, this ratio helps identify if a chain might be over or undervalued relative to the economic activity it's actually facilitating.
Okay, so value versus actual usage.
Kind of, yeah. For example, they calculated Solana's NVT ratio at 29.45 in the analysis.
And what about comparing them to traditional stocks again? Any familiar ratios?
Yeah, interestingly, the framework also applies the price to sales, or PS ratio, to public chains.
Price to sales. How does that work for a blockchain?
Well, particularly for DeFi protocols built on these chains that generate sales or revenue from fees, it's about bringing these familiar financial metrics into this new asset class to provide maybe a common ground for comparison.
Trying to bridge the gap. Makes sense.
Right. Now, should we quickly touch on some of the other crypto asset categories the framework covers?
Yeah, let's do that. First up, DAO tokens. Decentralized autonomous organizations. What's unique about valuing these tokens?
Well, they can actually have value beyond just financial return. They often grant governance rights.
Voting power.
Exactly. A kind of voting premium that allows holders to actually shape the future of a decentralized project or protocol. That right itself can have value.
Interesting. And what if the DAO holds like a big treasury?
Right. For DAOs that hold significant assets or treasury funds, the framework introduces a useful metric, net current asset value per token, or NCAVPT.
NCAVPT. Okay, what's that?
It basically measures their liquidation value per token. It gives you a clear sense of what the token is backed by in terms of actual tangible assets held within the DAO's treasury.
So like a book value per token, almost.
Kinda, yeah. It's a way to assess the fundamental asset backing.
Okay. Next up, utility tokens. How are these valued?
For these, the framework briefly explains the quantity theory of money, or QTM.
QTM sounds familiar from economics class. M times V equals P times Y.
That's the one. MV equals PY. This formula helps calculate the potential price level of a utility token based on its monetary supply, its velocity, so how often tokens change hands, V, the average price of goods or services transacted, P, and the volume of those goods or services, Y.
So it connects the token's value directly to the economic activity it facilitates within its own little ecosystem.
That's the core idea, yeah. Value derived from usage.
Okay, then we have security token offerings, STOs. These sound interesting, like a hybrid.
They really are fascinating. They blend traditional securities with crypto tech. They represent actual ownership in real-world assets.
Like what kind of assets?
Could be real estate, equity in a private company, maybe intellectual property.
Mm-hmm.
But it's digitally issued and managed on a blockchain.
So how do you value something like that? Is it crypto methods or traditional methods?
Because of that hybrid nature, representing real-world assets, STOs are typically valued using familiar traditional financial methods.
Okay, like what?
Things like income-based approaches, so discounted cash flow, DCF again, relative valuation using comparable analysis against similar traditional assets, and the cost approach, which looks at the reproduction or replacement cost of the underlying asset.
So the blockchain is just the infrastructure, the wrapper, but the valuation is traditional finance.
Essentially, yes.
Yeah.
The underlying asset dictates the valuation method, mostly.
Got it. Okay, finally, NFTs. Non-fungible tokens. Everyone's heard of these. They're unique digital assets, right? Representing ownership or authenticity of specific items, art, collectibles, virtual land.
Exactly. Unlike Bitcoin or Ethereum, they are not interchangeable, hence non-fungible. Each one is unique.
So what factors drive their value? It seems so subjective sometimes.
It can seem that way, but the framework highlights a few key, more objective factors. First, and perhaps increasingly important, is utility.
Utility?
Yeah.
For a JPEG? How?
Well, it's not just about the image. It's about what the NFT does. For example, Nike's RTFKT division creates CryptoKicks, NFTs, that grant exclusive access to real-world sneaker drops or discounts, or maybe virtual wearables.
Ah, okay, so real-world perks or access.
Exactly. Or think about gaming NFTs. They can act as literal admission tickets to play a game, or represent in-game assets that actually enhance gameplay. That's tangible utility.
Right, that makes sense. What else?
Second is liquidity.
Liquidity, how easily you can sell it.
Precisely. Higher liquidity, the ease with which an NFT can be bought and sold without drastically impacting its price, directly increases its perceived value. The source points to the case of an NFT project called DGods.
Okay.
When they migrated from one blockchain to Solana, which is generally seen as having higher transaction speed and maybe a different user base,
Yeah.
their floor price, the price of the cheapest NFT in the collection, increased by 12%. The argument is that this was partly due to the increased liquidity and accessibility on the new chain.
Interesting. So the market it trades on matters.
It definitely seems to. And finally, perhaps the most obvious one for collectibles, rarity.
Rarity. Like with baseball cards or stamps?
Exactly the same principle. Just like traditional art or collectibles, unique traits and attributes contribute significantly to an NFT's rarity and therefore its value.
So like CryptoPunks, where some have alien or zombie traits that are super rare.
Classic example. Those unique visual traits are incredibly scarce, and they demonstrate this perfectly. The fewer there are of a specific trait, generally, the higher the value premium attached to those NFTs.
Okay, utility, liquidity, rarity. Makes sense.
Gives you a framework, at least.
So, wow, what does this all mean for you, the listener, after this pretty extensive discussion? We've covered a lot of ground today.
We certainly have.
From Bitcoin's potential as like a digital institution to the unique ways you value public chains like Ethereum and even the specific factors driving NFT prices. I think the core takeaway seems really clear. Understanding these diverse valuation frameworks is absolutely crucial if you want to move beyond just the market noise, the hype.
Yeah, the speculation.
And make informed rather than purely speculative decisions in this, well, rapidly evolving digital asset space.
Absolutely. This deep dive hopefully provides you with a more structured, analytical way to think about why these crypto assets might have value, what fundamentally backs them, if anything, and what truly moves their prices beyond just sentiment.
It's about empowering you, really, to look beyond the daily, sometimes crazy fluctuations and understand the deeper forces potentially at play.
Well said.
So, maybe a final thought to leave you with. Consider this. How might these sophisticated valuation methods, which are being developed for digital assets, how might they not only revolutionize crypto investing, but also potentially influence how we value traditional assets in the future?
Interesting question.
What further applications of these frameworks might emerge as the lines between traditional finance and, decentralized assets continue to blur? Something to think about.